Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 303, that will be released on June 21st, 2021. My name is David Kosmeter. I'm the creator of TimingResearch.com, and but today is our monthly option professor solo episode. So he's going to give you his market outlook for the next few weeks. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody. Again, this is optionprofessor.com, and just to remind everybody that today we are going to share our opinions and our observations, and we're not going to be giving any advice to anyone because obviously you have to check with your broker for your suitability and make your own decisions on whatever, but this is our opinion and our observations that we're going to share right now. Okay. This week, we did send out an alert before the Fed meeting, and we are alerting people to the fact that we were expecting a volatility spike. And again, the reason we sent out the alert before the Fed meeting and before quadruple witching was because our feeling was that the Fed meeting was going to have to address these inflation numbers, which have been just going through the roof, and they were going to have to make a statement on what they plan to do as far as monetary policy. Obviously, there has to be a shift from emergency accommodation to normalization, and that boat got turned, obviously, on Wednesday. Friday, again, if you've been in options for any length of time or use common sense, you got to know that there's been an explosion of volume in the option market. I think somebody said it was 92% jump in volume. Whatever that number might be, it's enormous. And when they are going to have a quarterly expiration, which is what quadruple witching means, you are going to see order imbalances and you are going to get volatility. And if April was any indication, which apparently it was, the volatility is going to be up and the prices are going to drop. And that's exactly what happened. So we are very happy that we were able to alert everyone to that before the Fed meeting, before the volatility, and before quadruple witching. So kudos to us on that. But again, the question is where are we now? Where are we going? As we've been saying last week, we got a taste of what we've been talking about, which is that the market has lost its momentum, financials, materials, industrials, energy, et cetera, and is way too far from its long-term moving averages, which we consider the mean. And so we did a bit of reverting last week. The igniter came, as we said, in the two forms, the Fed meeting as well as the quadruple witching. And again, there has been an official turn in the steamship of Fed policy. And now the question is how fast is that steamship going to go to the island of normalization? And of course, that's going to be dependent upon data and how things pan out. But again, we talked, I think 2 weeks ago or more about the rotation that was happening out of value. I mean, we were noticing the banks weren't making any more new highs. We noticed materials and industrials were fading. We could see that the energy shares were having a heck of a time holding gains and getting above their moving averages. So this was no surprise to us, and we saw the rotation happening. Back into growth, back into near monopolies, Facebook, Google, Microsoft, Apple, Amazon, back into free cash flow and return on equity stocks, pharmacies, travel, leisure, and companies that were disruptors that were hurt by the fear of a spike in interest rates in Q1 and that the hike would lead to more hikes. And those disruptors are the ARK funds, Palantir, the cloud, WCLD, cybersecurity, and things along those lines. I'm sure you know what they are. So we've notified our subscribers as well as readers that rotation had commenced. And again, you noticed some of those areas did not go down. In fact, the ARK fund was up on Friday during that massive decline. So that obviously re-cemented our opinion that this is probably where, if we're going to go to those higher numbers, we're going to get drug up by those sectors much more than the value. Because the value and the banks and things that are related to the dollar, they got whacked. And why did they get whacked? Because the yield curve flattened, right? And there was a big flattening of the yield curve, right? So forget about the banks because they were benefiting from that. Forget about the materials and the inflationary commodities and those kind of things, because the dollar broke out above 91. It's up in the 92.30 area now. Is it going up to 95 or 98? There are some people who think it is. Is the world prepared for that? Probably not. Okay. So you had a strong dollar, you had a flattening yield curve. So all those value things got thrown out, but we don't want to throw the baby out with the bathwater just yet. And here's why. That yield curve that flattened dramatically, is that a permanent situation or was that an overreaction? We're going to find that out. If that flattening of the yield curve was an overreaction and it's not sticky, like Larry Summers was talking about on Wall Street Week, then these banks, obviously, and these the companies in the value sector that benefit from a steepening yield curve, they may come back. If in fact the yield curve flattening is not a trend, but a overreaction. Second thing is on the US dollar, of course, we had a nice big jump, but the overall big trend on the dollar is still down. It's gone from 104 to 88, 89 on the dollar index. So we popped back to 92, 93. 38% correction on that takes you back towards 95. 61% correction of that takes you to 98. That's where I came up with 95, 98 potential. But there's no assurance those targets are going to be met. And if the dollar starts reversing to the downside and the yield curve starts steepening again, and it looks like happy days are here again for the value stocks and for the commodities, then they're going to go back up. So you can't hang your hat on one day and one reaction. It's not enough data to do that. Okay, so that's something to keep in mind that we're trying to show people as well. On the international markets, of course, those stocks got whacked a bit because the dollar got strong. But again, there's a long runway out there still. We're still reopening, but we're getting there pretty much. As I said, and we said, July 4th would be our target date to be up and running and pretty much right on. Our target date for Europe is Labor Day. And I think by Labor Day, they should have their stuff together. England did extend their opening to July 20th. So that's still before Labor Day. And I think by Labor Day, it should be in full force. And then by the end of the year, hopefully Asia and emerging markets will get their act together because their vaccinations are so far behind the 8-ball, it's a joke. Some of these countries like Korea and Japan have like 9 to 20% vaccination rates. I mean, what's going on? It's going to take some time. So that's why we said by December, you'll see a better reopening in emerging markets. So that is the story that you're seeing right now. And again, we did send out also a alert on how to hedge portfolios using replacement trades. And essentially what you're trying to do there, generally speaking, is to reduce your risk, but stay in the market with some type of position that would benefit from an upside move. For instance, as an example, ballpark example is you had the banking stocks, you had the energy stocks, you had the industrials, and you had the materials, and they were all very highly valued, right? And you had a big run on them, right? Okay. Well, when you see that they stop making new highs, that's your first tip that they're running out of steam. They start taking out the previous daily low or the previous weekly low. That's your confirmation that it's running out of steam. And then at that point, you might want to look to selling out what you own and replacing it with a call spread where you buy one option and sell the further out of the money option. So you create a spread because the premiums are rather high. So obviously you're trying to offset that volatility, that implied volatility premium that's quite high by buying one and selling another. It does keep you limited to the difference between the two striking prices as far as your upside potential. But it does take your risk down from all that money you have in the stock to whatever the call spread's going for. And if the market's going the tank like they've done, you'll lose on the call spread, which will be minor compared to what you lose on the stock. Some of these stocks have lost 20, 30, 40 points or more, and you might have only lost $5 on the call spread. So if you have any further questions on that, you should subscribe to optionprofessor.com/subscribe and throw us an email, and we'll try to give you a legitimate answer on your questions. But the concept is essentially trying to change the risk profile from a fully paid stock to a limited risk option. at a point where you think there's a better than even chance that the market might be running out of steam, and you want to make sure you walk home with as much money as possible when the cops come and they blow the party up. So the bottom line is that gives you a little bit of an idea. There's many other ways of hedging as well: married puts, collars, trimming, and even covered writing will give you some downside protection. So there's a whole bunch of different ways to go. Again, when you subscribe to optionprofessor.com/subscribe, obviously if you look at the rate that we charge, it's peanuts. It's absolutely a joke compared to what you get. And also, you have the ability to shoot us an email if you have a question. So that's an awful lot of value for very little money. I see what these other people are charging. So, I mean, it's absolutely off the charts what they charge. Some of these people are advertising their service, and they're saying, and we recommend Netflix, Google, and Amazon. Well, do you need to subscribe to a service to get Google stock recommended? Come on. I mean, it's an absolute joke. So at any rate, we do believe we have a good value that we show you, and we're going to give you more value here today during this broadcast. Okay. On your screen here, you see that we have got the S&P 500. Now, this week we've got some things coming up. We've got the Fed chairman in front of Congress. So, they're going to spend the whole week explaining that the world's not coming to an end. You know what I mean? They're going to explain that, we just said we're turning the boat around. We didn't say we have a scarab here and we're going to go with a scarab back to shore at 100 miles an hour. We didn't say that we're going to pull the plug on all the easing. We didn't say any of that. We just said that the boat is turning around and we're going back to the island of normalization, and the speed of how we go back will be determined about how things pan out, which is pretty logical. And that's exactly what they should have said. And that's why the market's normalized in price, because they're starting to talk normal now. But let's face it, you've got the entire planet printing money like nuts. And you've got there's 20% of all dollars that are in circulation have been printed in the last year. Do you have any idea how massive that is? Now throw in Brazil and throw in Europe, which is just beginning their stimulus, and throw in Japan, which is a printing machine, and throw in all the rest of the countries that have printed money, central banks. And you've got a tremendous amount of stimulus out there. And then you've got bottlenecks on supply. I mean, come on, what do you expect was going to happen? Of course, prices are going to jam up, right? Now, are these bottlenecks and supply chains going to correct themselves over time? Yes, but how long are they going to be? I don't think they can say with certainty. And according to the guy in Bank of America, all the stimulus checks, 65% of them are still sitting in the bank waiting to be spent. So that's a big tailwind as well. In addition to that tailwind, you got capital expenditures that are supposed to be increasing. You've got, again, the stimulus coming out from other countries and reopenings that have not even happened yet. Europe isn't going to be reopening for another month. Phuket, which is over in Thailand, Asia, that's not opening up until July sometime. So there's a lot of runway on the reopening thing still too. And corporations have got a ton of money. So, this is not something that you want to say the party's over just yet. So we're looking for this pullback to have a low point, and we're looking for a resumption of the uptrend. But unless the yield curve, which flattened like a pancake, expands and the inflation numbers remain sticky, it may be difficult for some of these value things to get back on their bicycle in a fast way. But if the word gets out that GDP will be dropping from these levels, inflation will be dropping from these levels, and interest rates are not going up, and we're in a low interest rate environment for a very, very long time, well, that's going to open the door for tech and disruptors and growth and things like that, which clearly in the first quarter were way down and underperformed because of that fear of the Q1 spike in interest rates, which at this point looks like the taper tantrum that everyone's been talking about. At this point, that has been, unless we see proof of it not. And proof would be take out 175 on the 10-year, take out 255 on the 30-year. Until that point, everything is a conversation. That's it. Okay, so now you see where the S&P is. Now we're going to look at things here today on a long term, intermediate term, and shorter term basis. So you'll get a little perspective with 3 periscopes, right? Okay, on a long-term basis, this is why we say this market will not go on like this forever. Can you see, this goes back 20 years, and can you see it ever very far from the blue line like it is now? Now, clearly, we have unprecedented stimulus, so that's probably why we're doing it. But they're going to be in the process of taking it away. But that process could take time. But that doesn't mean that it can't have a correction toward it. Now, the 3 moving averages right now on the long-term graphs come in at 37.36, 37.32, and 31.81. So we're still over 1,000 points above the long-term moving averages. And my screen just got a little bit nutty here, so I'm going to try to get that chart back. Give me just one moment here. There we go. It's coming back. All right. So anyway, that was the long-term graph. Now you understand why we're saying it's very, very overbought and it's going to come back to the mean at some point. So that's why I tell people, you want to know how these hedging tactics work, because whether you need the umbrella right now or you need it after Jackson Hole at the end of August, you're going to need an umbrella. You're going to need a raincoat, because this thing is just not going to go ad infinitum up. This is not the never-ending story. All right. So that's your long-term. Let's go to something more intermediate term, like the 5-year. Again, we came back and touched that line. So this is why there could be some support in this neighborhood around 41.75. You see that line there is 41.75. Do you see what the low was today? Friday, 41.65. Where'd we close? We closed right on the low. So it's hugging that line. The next one down would be and this is where we think it could go if it really unwinds next week, somewhere around 4,000, 4,100. Okay. And then further down from there would be your 38.75. We haven't broken the green line ever since we broke above and got positive around 3,000. Once we got above 3,000, it was right back in the game here, right? Once we broke under 3,000, that was the end of the game here, right? But we've been kind of going all the way, and we haven't even touched the blue line, and we've hit the green line one time. So if we're going to go down and test the green line, you're going to be looking at somewhere 4,100, 4,000. And if we bust that, your next area is around 38.75. Let's look at shorter term. Shorter term looks bad, right? Looks like it broke. But, you know, the red line and the green line and the blue line haven't crossed. So just like when we dropped here, and that was back in May, where we got a pretty good drop. We broke the blue line, but once you got back above it, you were back on the bicycle. So right now, to be honest, you'd like to see this thing get back above 4,200 and 42.24 if you really want to be bullish and you want momentum. You know, if you got above 4,200 and you got above 42.24, then you could buy back into the 4,300, 4,400, and 4,500 story. But if you are looking to be catching a falling knife, that's exactly what you're doing right now. If you're a guy who likes to see higher highs every time you buy something, you know, then you need to be above the moving averages. As you can see, you want to be above the moving averages if you want to see growth on the values, right? So there you go. All right, let's look at a very short term, which is your monthly. And that broke and gave you the sell signal pretty much at 42.40, 42.30. So obviously should have been out or hedged, right? Okay, so there's your story on the S&P. Why don't I give the guys over in the tech sector a little bit of a look here. Let's look at QQQs. Nope, what happened here? Okay, let's get this up here. QQQ. Okay, put in the QQQ. All right, we're going to look at QQQ from, again, long-term, intermediate, and short-term basis, okay? So let's get back out to the 20-year deal and see what it's telling us. Again, just like the S&P, this thing is in la-la land, right? Okay, and again, when you're in la-la land and speculation is at an all-time high, like SPACs and Reddit and all that other stuff, you know, you got to be concerned about what? Sometime it's going to go back and revert towards the mean. Now the Qs, what do you call it, are trading at 342. You have 306, 257, and 230. Okay. When we got the big collapse, obviously that's a good example on why you want to buy against the lines, right? I mean, everybody was panicking of every stock, but if you had this graph in front of you, you would have said, I'm buying. Why? Because the last time it hit the line back in 2018, when the thing was panicking, that was the best time to buy. And then you got another bite at the apple during the crash of March of 2020. That's the best time to buy. Is this the best time to buy? I don't know. Anyway, that's what it looks like on a long-term basis, and that is not so pretty from the standpoint of being overbought. But you did get down here in the month of March, close to at least the red line, and that was the great time to buy, right? So that's why we use the moving averages, because moving averages don't lie, people lie. They're based on price and time. You can't argue with price and time, can you? It's not an opinion. It's a fact. Doesn't tell you exactly where you're going, but it certainly tells you where you were. And it gives you a little bit of an idea of the flow, right? Okay, that's the long term. Let's go intermediate. Intermediate term. Okay, again, on the intermediate, oh, let me check that out. Put up the 5-year, come on. Yeah, on the intermediate, look at the blue line. That's the long-term 3-year, right? 36 month. Look at this. Come down here, you buy it, right? Come down to the green line, you buy it. Right now, it's on the upside. So here, you would, if you wanted to have some kind of a trailing stop, you might look at 335 or 327 and see if it can accelerate from here. Looking at the shorter term, which is your 1 year. Again, got above the red line here. So where those averages come in, 339, 334, 332. You don't want this thing under 330 right now. Absolutely not. And then if you go to the 1 month, it got broke here, but it's back above it. So again, even on a short-term basis, 341, 342, it would be an area you'd like to see hold. But if it breaks that, then you refer to your longer-term charts. And again, your longer-term charts come in here on the 1 year, which is call it 330 or keep it above 330. And then on the intermediate, you definitely would like it to keep it above 327, 317 if you're a longer-term holder. And then at least stay above the red line here because you don't want to wait to the green line. And the red line comes in at 307. So there's your QQQ. Okay. Some people are playing the Russell for the small caps. And there you go on the Russell on the 20-year. Again, very, very overbought, right? Look at where the averages are. They're way down here. We're way up there. So again, that's where our concern is did the market already top? It's possible 4250 is the end of the story. It's possible. We're going to know that probably in the next week or two. Because if it starts tanking underneath 4,000 on the S&P, then 4250 is going to look like it could be the high point. But if we just get a pullback here this week and we hold 4,000 on the S&P and then we start going and then the yield curve starts non-flattening, starts widening out and the inflationary numbers in the weeks and months ahead continue to be sticky, but interest rates still remain sanguine, then we probably got another big leg up before they suck everybody in and then roll it over. All right, so there you go on a longer term basis. Now let's go to the intermediate term. Again, it's holding the green lines on a IWM, which is the proxy for the 2000 there. And then looks like 222 is where it closed. And so that's right on the green line. And then if you go to the 1 year, again, it's broke on the 1 year. So again, if you're looking to get into a trending market that might continue up, you'd like to see it get above 225, get above 230, because that opens the door for 240, 250, or 260. 215 doesn't open that door. So again, sometimes it's better to just sit back, let Rome burn. And then when Rome can show you that the car is working and the car is functional and it's back on the road, then you come back into the road. That's not bad input either. You don't have to be in there 100% of the time, you know, if you're trading particularly. So the bottom line is you want to be in, if you're buying things, you'd like to have them higher after you buy. And it's difficult to go higher after you buy if the trend's down, right? Right. Okay, so there you go on the, what's this chart? The 1 year, let's go to the 1 month. And you can see this thing told you to get out around 230. And so there's no reason to be in it on a short-term basis. If you want to catch a falling knife, good luck to you. That's what you're doing right now. And of course, like I say, if they come out and change their tune, and if everything that happened this week turns around, then of course you're going to get a bounce back up. But as far as taking and making any huge moves, until you get above, like even on the dollar was in a downtrend, but if it got above 91, it was turning around. And it went from once you got above 91, it went to 92.31 here on Friday. So, you know, things can turn around, but, you know, right now, that's not the evidence you're looking at. Okay, so there's your, and then I'm going to go over one last one, which is the transportation average. Now, this thing has been a dynamite situation because obviously everyone was buying stuff online during COVID. So FedEx and UPS were delivering them, making a ton of money, right? And the railroads make money because, I mean, there's no competition. It's a monopoly. You can't build any more new railroads, right? So there you go. Now, you had a very big move on it. And I'll show you that on a long-term bid. This is a proxy for the transports, IYT. And look at that. You know, once you got above 190 here, it was off to the races all the way to 280. Again, very overbought, so it's trying to come back to the mean. Let's look at the intermediate term. You broke the short term, so now you're going to try to hold on to the green line. The green line comes in at 251. Blue line comes in at 240. Okay. That's called reverting back to the mean. And it always happens no matter how strong things are. Up here, you're strong, revert back to the mean. Up here, you're strong, revert back towards the mean, right? Market goes into the collapse mode down here, you revert back towards the mean. All right, so there you go. How about on the, well, that was, yeah, this is, now we're going to go to the short term. Yep. Yeah, you got a big break here. So really, until you get above 270, this momentum's down. So if you're the kind of guy who wants to wait until it starts looking a little bit more like that, you got waiting to do. And this is one of the reasons why, you know, some people are thinking that we might have hit the top at 4250 S&P, and we might have hit the top at 15,000 or whatever on the transports. And, you know, we might have hit the high points here because on a shorter term basis, it has rolled over and it's underneath its moving averages. Well, what happens is the longer you're underneath these things on a shorter term basis, the lower you go, it turns the intermediate term down, and then ultimately it turns the long term down. But the long term is going to be hard to turn down on this because there's so much real estate between our prices and where the long term averages are. So that's why on a longer term basis, the stock market still looks good because the long term average on the S&P is in the 3100 area. So you could drop 500 points and the long term trend is still going to be up. But of course, if you drop 1,000 points on the S&P, that's a heck of a lot better buy than it is today, right? Right. And that's why you want to have some cash, you know, in case things like that happen. And that's what asset allocation is all about, where you have more in stock or more in bonds, you know, or where you go to cash with some. And, you know, because since the money market pays nothing or, you know, bonds pay very little on a short-term basis, some people might say, listen, why do I want to take any chance on that? I'm putting up all this money for 1% interest. I might as well just keep it in cash, earn nothing. And then if my stocks drop 20%, I'll consider that 20% discount my return. So anyway, that's the story as far as the transports are concerned. Let's take a look at just a couple of these things here, like the ARK fund. Because I was telling, well, we were telling people that the moving averages were converging at 116 and 114, the 50-day and the 200-day. So it was crunch time for this thing. Well, so far it's successfully entered the call for crunch time, because can you see as it got into the 115 area where the red line is, the red line is now pointing up, which is a nice sign. And the market at the red line is at 114 and the market is trading at 118 and it was actually up. You see that up on Friday, right? So that's why we bring people to the attention on not where the puck was, but where the puck is going. And right now the puck's going right here. Now, will that continue? I don't know. That's why God created the stop loss, right? But the point is what? You're looking at a market that might be turning because their circumstances have changed. What is their circumstances? The big fear that their earnings that had to be discounted because of higher interest rates don't have to be discounted anymore. And ergo, that changes the story. And the story has gone from 160 down to 100. And now the story's at 118. And if that story is going to remain, that interest rates are going to be low for a very long time, so you don't have to discount future earnings like you had to, then these things are going to make more sense. Because the people that are disrupting that they have in there, like Palantir, et cetera, may be a very good value. And ergo, this could be on the process of matriculating back up. It's early yet, but why not look at it now rather than if it goes to 140 or 160, it's on the news, it's on the Reddit list or whatever it goes to, and all of a sudden you're buying into a high point. So that's why we're looking at something like this. There are many other things we're looking at. If you go to optionprofessor.com/subscribe, put up a little bit of money, you're going to get a lot more in our view, in our opinion, than you paid for. And that's why we feel very good about what we do. Okay, so that just gave you a little bit of one thing that we're looking at. And of course, there are many others. All right, let's go around the horn here and give you some more information. We went over the stock area. Right now, I'm going to give you some broad strokes on the bond market. We look at TLT. Now, when we were at 133, 135, and 175, and on the 10-year, and we were telling people that this is not the time to panic because, again, there's a very good possibility that these GDP numbers, which are off the chart, are going to be lower in the future, and it's very possible that the GDP numbers this year will nowhere near be matched next year. So that means a slowing of the growth, and the inflation that's being caused by bottlenecks and supply chain problems, they are not permanent. So that could quell some of the inflation. I mean, certainly off of the double-digit rate that it's been going at, right? Right. So that would be positive for bonds. Plus, let's look at this. The government's fiscal deficits are so large last year and this year that is it possible that rates are going to go way up? It's possible. But how the heck would they ever be able to fund the government with higher interest rates? So, the Fed can print money and buy stuff. And I think they would do that before they let interest rates go very far up. So that's why this thing has been a buy, as we've been telling people, right, since 136, right? And that means rates are dropping. Yields are dropping, not going up. They're dropping. And the whole planet, all these talking heads on all the TV shows, rates are going at 2%, 2.25%, 2.5% on the 10-year. Are they? Well, you better tell the TLT because that's not the way it's going lately. And you see those moving averages when they start turning up? That means the trend is turning up. Now, I will give them this. Look at this 20-year graph, and it'll show you exactly why we were telling people to buy when it came down, just like during the crash of March of 2020. It came down to the moving averages, and now it's back above the blue line. So as long as we're above 141, 140 on this thing, we're going to assume that the drop in the TLT, which is the bonds, because rates jumped up. I mean, this was a panic top. Okay, that was when we had a panic low because of the crash of March of 2020. That is probably something we're not going to see, and you don't want to see, because if you see that price again, that means our economy has gone in the toilet in a very big way, and they've had to drop interest rates back to the panic lows of March of 2020. So I'm not saying they're going way back there at all, but I am saying that they could clearly see further decline in rates, or just stabilize between 140 and 155 and stay there for a while. right? And if that happens, again, that would not be negative for growth or the disruptors or any of those interest rate sensitive stocks. So that's the story there. Now, if you take out, like I've been telling people, if you take out 135, I'll jump on the boat that says rates are going higher. I'll jump on the 2.5% 10-year boat. But I'm not jumping on that boat when it's going away from the island. I want to stay on the island. And the island is down here. That's your island, right? And the boat, our boat, is leaving the island here, right? And the people down here who think we're going to 130 or 125 right now are wrong. But we have humility. And what does that mean? That means if it starts going under 135, we will admit that they are correct and rates are rising. But we're not going to do that with any proof. I'm not looking for Swami. I'm not looking for Kreskin, the guy who used to tell you, or Nostradamus, the guy who tells you what happens tomorrow. I'm looking for evidence. And the evidence right now is not that interest rates are rising, but in fact, they look like they are either stable or declining. And then, of course, on a shorter term basis, on the intermediate term basis, again, it could run into some resistance up here on an intermediate term basis. That's why we're saying we're not looking at any huge drop in interest rates. But what we're saying is that the rain stopped down here, and stable to lower interest rates right now seems to be more likely. But if I was a guessing man, consolidation is your best case scenario. Unless GDP really collapses, unless the stock market really collapses, unless the inflation really collapses, then of course, you don't know how low the rates would go in that environment and how much easing again the Fed would have to do. But that's not the high probability case right now. Okay, so there's your interest rate story, and now you understand why the growth and the disruptors and the FANG stocks are doing better. Okay, and again, we will be covering the near monopoly stocks in our newsletter as well. Okay, let's turn to the US dollar because that's a big story. We just talked about the yield curve thing, right? See, that's the one that hurt the banks, right? But again, remember this about the banks, and here's a double whammy on those. Next week, they're having a stress test on the banks, right? And if they pass the stress test, you know what they can do? They can return capital. You know how they return capital? They increase their dividends or they buy back their own stocks. Both of those would be very good for the banks. If you take that and you combine it with the yield curve expanding because they overreacted when they flattened it last week, then you're going to get something happening in the banks before July 4th. That could be a good trade. So keep an eye out for that because you got two very big things happening. You got the stress test and you got return of capital. Those are two very powerful things. If you add into that the yield curve starts expanding again, and you see these stocks like JP Morgan have gone into the tank. In fact, let's go over there real quick and so I can show you something. This is an example with JP Morgan. Let's see what it looks like. Let's see if there is something there. JP Morgan, in our view, is the Cadillac of the banking stocks. Okay, so JP Morgan on the 5-year did break its moving average. Let's see what it looks like on the 1-year. Yep, it's broken totally. So this is a tough racket here as far as buying, and this talk about buying a falling knife. Okay, so where could you hang your hat right now? Well, the way we'd suggest you hang your hat is use the green line. And what does that mean? The green line is the 24-month. It's at 150. Where'd the stock close? 148. Okay, you start getting back above 150. And this thing holds its lows from last week, then that might be an indication you're getting back on the bicycle. So I would look at 151 as an area that might be interesting if it gets back above that, because then it would be at least back above the green line, right? Because you can see down here when you got above the green line here, and then you got back underneath it, then it started to go down again. Okay. So the bottom line is getting the direction of the green line is up, which is still good. The blue line is definitely up, but I don't know who wants to give it, well, if you want to give it 10 points, use 138 and change as your exit point, which also might be where it could drop short term because these are highs. So let's say early next week, Monday, Tuesday, they panic this baby down to 140. You'll be able to notice that it's very close to the blue line, which is 138 and change. And you'll see that it's coming off of these high points, which are now should be support, which comes in at these highs are at 141, 140. So it's 147. Could they drop it $7 on a panic Monday or Tuesday? Of course. So if they do that and it holds these levels, that would be the line in the sand. That could be the trade. If it holds 138 to 141, and then if it gets back above 150, that would be very impressive. 151. So if you're into the banks or if you're looking for something, those would be the points that we would see. And again, if you subscribe to optionprofessor.com/subscribe, this is some of the information we can share with you as well. Or you could email us and ask a question like this. But again, that's the way I would see it. And again, like we talked about NVIDIA, I'll give you an example on NVIDIA. I'm jumping around a little bit here, but what the heck. NVIDIA. Okay. When it went down and then they announced their buyback, their split 4-to-1 approved in June, going to be happening July 4th. We said that it's possible it's going to go way up, just like what? Just like Apple did. And then it may have trouble after it runs up. Well, this was down around 570 to 600. And as you can see on the even on the 1-year graph, let me show you that. Yeah, just using a simple 1 year 12-month moving average, right? Once it got above there and then it got above the blue line, that's when they announced the split. So we said, why don't you get in there and use either a short term, which was a 10-day, or a 1 year moving average like this, and follow it up and just stay with it until it breaks. And can you see it has never broken? And then on Friday, it had a blow off to 780. Now you're way above the mean. And if you get that far above the mean and you bought down here, this would be where you blow out the stock and put a call spread on at 780 against 850 or something big like that. And then basically maybe that spread cost you $5. Well, if you got in here at 600 and you get out at 780 or let's call it 760, that's $160. So you take your $160 off and you throw a $5 call spread on there just in case it's going to keep going. And then if it goes back down here, rather than losing the $160 or part of it, all you lose is the call spread up here. And that's a replacement trade, and it's exactly why people use them. But anyway, we brought this to the attention of our readers, and obviously that was something that very much was worth the peanuts that they pay on a monthly or annual basis, which if you go to optionprofessor.com/subscribe, you'll see what I'm talking about. All right, let's get back on the horse here and give you some more stuff. We went over the dollar, we went over stocks, we went over the bond market. We were going over the dollar. Let's go over the dollar again. US dollar index. US dollar index. Oh, they're not giving me that. Well, anyway, I'm going to keep going because I'm having a hard time getting the dollar index up. But again, on the dollar index, we made it as clear as a bell. It was at 104 last year. We told people that that was way, way overbought and that the dollar, when they dropped interest rates, was going to lose its yield advantage and the dollar was going to drop. Exactly what happened. We lost our yield advantage when our bond market collapsed. Our bond market went through the roof because of the crash, and ergo, we lost our yield advantage when the Fed started cutting rates, right? Okay. Then we went down here to the 88.90 area, right? And that we said was very low. And again, the whole world got very very short. And so we thought there could be a rebound up. It went up to 93 and change. Now it came back down, tested the 88.90, and now it's back to 92.31. Okay, until we take out 88 on the dollar index, I wouldn't get very negative on the dollar. 88.89. If you take that out, then of course that's a different story. But right now, getting extremely negative on the dollar, especially if we're going to be changing the steamship of the Fed policy. It might not be the Phi Beta Kappa thing to do. Okay, now let's talk about some of the commodities that got whacked, and we'll start out with let's start out with crude oil, because crude oil didn't get whacked, but the energy shares have had a hard time going up. That doesn't mean they can't, because any price on crude above 55 generates a lot of free cash flow for those companies, particularly the leveraged ones. So while we are not positive on the energy shares right this second, because they are, like everything else, on the defensive, we are very willing to come back in once the shares get above the moving averages and reignite their uptrends. But right now, they've broken their moving averages, and that's why we don't like them. That doesn't mean crude has done that. But again, here's your 20-year graph on crude. And you can see that as long as it's above 50, 55, again, these companies can make money with cash flow. But rig counts are increasing, particularly in the Permian area. And also the demand has been spotty because of the staggered openings of the post-COVID situation. So there you go. You've got the oil market on a long-term basis running into some resistance, but that's where they're getting 80 from. It looks to me like if it goes to 80, it could go a lot higher than that. So the bottom line is 80, I don't think, is the end of the story. If you look at the intermediate basis, you might see, you can see that we're getting a little extended on an intermediate basis. Moving averages come in at 55 to 65. We're up at 72. So could there be a pullback? If this high here has a lower RSI than that high there, that would be an indication of exhaustion. So you guys who have the RSI, I don't have time to go through it right now. If you were a subscriber, you could shoot an email. I could help you with that. But the bottom line is that, if there is a lower RSI on this high than this high here, that would be an indication of exhaustion and would increase the probability that you might pull back. Again, here you go again. It is taking out the 1-year average here at 70.56 on the lows, but it's been closing above it. So it's been teasing you that it's turning, but it's back above it. And if it does turn, going back to 68 or 66 is certainly not off the charts. These high points here could be support. So that'd be 66 to 68 area if it starts pulling back. If it gets under those levels, then it's more severe. All right, that's the oil market. Let's take a look at the metals. Well, let's look at grain. Because again, we're going to show you this real quick because I just want you to see what we were talking about in the newsletter. Again, we share our opinions and our observations. That's all we're doing. We're not recommending anything to any specific person or giving any advice. This is just our opinions. But here's the deal. We got positive on this thing here when we were down in the 8-9 area, and you'll see why. You see here in 8-9, all the lines cross, right? And that's when we got positive. And actually, to be frank, we thought it would stop at 12. Once it got back above 12, again, you have to get back on the bicycle. And then when you go way up here, obviously you're so far away from the mean, you've got to figure it's coming down. Now, again, where would you get some kind of a signal that it's exhausted? Well, let's look at a more of a shorter term chart and see if you can see. This is intermediate. Well, look at this. You've got the high point, then you got the correction. Then you got the high point that doesn't take out this, and then you take out this point and school gets let out. That's called a 1, 2, 3 formation. 1 down to 15, 2 back to 16 and change, but don't take out the high. And the third move is the big kahuna, where you take out 15 and you collapse down towards 13. Now, again, it's back above the blue line, so it may go back up from here. And that's why commodity inflation may not be gone. But again, this was weather related and this was bottleneck. And then, of course, China, your biggest buyer, is saying they want prices on commodities to come down. You don't fight the tape when they want to do that. They're the biggest buyer. They can pull orders. They have reserves they can put on the market, whatever they want to do to get those prices down. And obviously they succeeded. So that's the grain situation right now. And then basically, let's take a look at coffee, because these are the 3 ones that we were very, very positive on last year, and they definitely went up very nicely. This is the only one I got here right now, which is the 2022 contract. It just give you a flavor for what's been going on, no pun intended. And as you can see, last year, right? Last year, it crosses the lines. Now we got 2 trades out of this thing from the standpoint of opportunities. It got above here, boom, came back to the mean, got back above it, boom, back to the mean, boom, and now it's trying to come back to the mean. Again, as long as it stays above this 135 though, and above 130, it's still in an uptrending overall situation. So commodity inflation has not left the building. It has just corrected at this point. Last one is sugar. So people were wondering, why aren't you still positive on soybean, sugar, and coffee? And again, our response was because they went up too far. That's why. This thing got us very much into this thing at around 12. In fact, it was around 12:30 where the 50 and the 200-day crossed. And then bam, comes back up, then back to the mean. Then way back up, then back to the mean. Now, if we don't take out this 15 cent area and we start taking out 18, it opens the window for what? For all this stuff up here. Okay, so commodity inflation has not gone away. It has just corrected at this point. All right, let's turn to the gold and silver. Gold, where are you? Okay. All right, as you can see, again, got positive here at 13, ran up, came back and broke the moving average, right? Obviously, when it breaks the moving average, you got to be very concerned, but it held the green line. We also told people that the move from here, where it started, all the way up to here, the correction was 61%, which is your Fibonacci, and that was 1675. So that, and then the green line was there. So that's why we told subscribers this is a turning point. We also told them it seemed to be having some resistance up in this 1950 neighborhood. And once it got under this number, which is what? 1840, that's when we got the vacuum all the way down here last week. Now, if we get back above 1840, then we would become constructive. As long as we can stay above this green line, which comes in where? At 1706. So if you stay above 1700, and by the way, the distance between 1675 and this move at 1920, 61% is 1770 area, which is where we are. So it could hold here because the correction, but worst case, you definitely want it above 1700. Now, if you take out 1675, that's not good. It'll be opening up the door for significantly lower levels. So if you're bullish on gold, you're holding something that's not working right now, you certainly want to make sure it holds 1700, and you're back in the pink if you can start closing above 1840. And if it gets above 1920, then you're off to the races. So there's your lines in the sand. 1700 ballpark, 1840 to get back on the bicycle, and 1920 to open the door to the higher levels. 1675, that's not a good sign if it breaks that. So you've got support 1675 to 1700, right? You got a resistance at 1840 and then 1920. Okay, again, inflating all over the world, printing money all over the world, inflation's up all over the world, okay? So there is a reason that these things could still pan out. And after Jackson Hole, it could get a lot different. So we have not dropped the ball on these metals at all. We'll have to see how they pan out. But if this train starts running, it's a train that I would hop on. Silver. I got to get 2 more in here and I'm running out of time. So we're going to go fast. Okay, silver's holding the red line. So where's the red line come in? Comes in around 25.50. Let's keep that baby above 25.50, and that would be a good sign. If you break 25.50, that's not so good. It opens the door to 21 and even 19. So if it's gonna really shake you out, it's gonna come back towards 20. If it's gonna be behaved, it's gonna stay above around 25.50. All right, let's look at copper. Now, again, let's look at FCX, because this is something we got bullish on back around $10 a share. And obviously it was a home run derby. So what about now? Let's see about now. I'd like to know now too. On the 20-year graph, look, you're way up here. The averages are way down here. You don't have to be a genius to figure out that it's going to gravitate back towards the mean. But you've got electric vehicles, you've got infrastructure, and a whole bunch of reasons why this thing could keep going. So you should be looking for maybe some place to get on the boat. As you can see, do you understand when it broke above 10, that was the time to get in, and then add above 15, and then let it ride? Maybe do a replacement trade up here where you blow it out and buy the calls. And now you're only stuck with the $50 calls rather than a stock that's back to 35. Again, that's why replacement trades make sense sometimes. Let's look at intermediate to see if that gives us a signal. Okay, it broke here. So we'd like to see FCX get above 36 to get back on the bicycle and above 38 and change. So basically that's what you're looking at. And if it's going to go down to the blue line, you'd want it to stop at 31. So 31 to 35 area could be an area of support. Okay, so keep an eye on those numbers. And if it does that, that might be a place to take a look at it. Otherwise, if you're going to go to long-term stuff, it's going to be more like 27, 25, 20, oh, no, call it 20, yeah, 25. Okay, last one's Bitcoin, and we use GBTC on that. Now, this is something that you got to buy when it drops. And we've been telling people that all the time. I mean, if you're going to speculate, which is what it is, it's a store of value. It's, obviously a digital currency, but it is something that, again, it has only a fixed amount of supply. So that makes people interested as a store of value. But it is clearly on the defensive. But we measured the move from where it started up to the top, and then we took 61% off, and we came up with a number of 28, which has been about the low. This is on GBTC. The low here says 26. So it went through the line a little bit. Another measurement had it at 20 to 22. So somewhere between 20 and 25 should be the area of support. Right now, that looks like it could be the low. If it gets back above 35, that would be great. And again, that above 25, that would be reinvigorating the uptrend. Okay, so if you're in the Bitcoin or looking at the Bitcoin, again, you buy the corrective stage. You can't make money if you're buying the high and then getting wiped out. But if you buy when everyone else has sold, that is a better time to get in. So again, if you're looking at Bitcoin, this is the neighborhood where you'd look. We did look at Ethereum, and that could be a good situation, but our concerns there is that if somebody comes along with a better mousetrap, kind of like Google did against Yahoo, the search engine game, they did a little bit better than Yahoo, and all of a sudden you can't remember Yahoo. Well, if somebody comes along with a little better game than Ethereum for the programmable blockchain, then that, of course, that could put them in the Yahoo camp. So that's why we're a little concerned about that. So we're more focused now on the Bitcoin. And again, you can see from the chart, that does look like the low. Our measurement was around 28. So we'd like to see this thing stay above 26, 28. But if it does break, the next level would be 20 to 22. All right, so that's the story there as far as an overview, and gives you a little bit of an idea of some of the areas that we can cover with the newsletter. And that's why we do suggest that you subscribe. If you go to optionprofessor.com/subscribe, you'll see that the rate is absolutely peanuts. And you can see from listening to me speak, we have a lot of information that has been gleaned over decades of experience that we share. These are our opinions. These are our observations. We're not giving out advice. We're not recommending anything. But with the freedom of speech, we are allowed to share our opinions, which is what we're doing with you here today, and which we do each and every week with the newsletter. So we do encourage you to subscribe. Again, we think you'll get more out of it by a long shot. So we think there's a lot of value there. And again, we give you a wide scope of all different things that are going on in the investment climate. So I did want to thank you for being here today. This has been optionprofessor.com. And again, we do wish you all the best, and do consult your broker, your advisor, and your brokerage firm to determine what, if anything, is suitable for you. And then hopefully the information we share will have some value as well. So again, do go to the website, optionprofessor.com/subscribe. Take advantage of it. And again, hopefully you'll join up and we can be in touch each and every week. Thank you very much for listening. This is optionprofessor.com signing off. Until next time, have a great day.
Right, and just a reminder for everyone, please be sure to subscribe to Timing Research on YouTube and your favorite podcast app. And you can also go to TimingResearch.com to get access to any of the past shows and reports. And thank you again to the Option Professor of optionprofessor.com for today's market overview. Thanks, everyone.
Thanks, David.